Okay, welcome to another episode of Coffee with Samso, where we talk with CEOs and company directors, identities of the industry. And today I've got Davide Bosio from Shaw and Partners. We've had a conversation, must be over 12 months ago now. Markets dramatically change. Look, I just want David to give us a view on how the market's going and going forward.
Yeah, well, it's been, I think last time we caught up, it was about, must have been just over 12 months ago, and we talked about DJ Carmichael being acquired by Shaw and Partners. Yep. So a lot's happened since then. We're filming from our offices here in Western Australia in St George's Terrace. So I appreciate you inviting me along again, and a lot's happened between now and when we last caught up, and in particular the markets have been fantastic. We've had what's been hopefully a once in a lifetime event, given what's happened with the outbreak of COVID and the pandemic, and we saw markets really get hit very, very hard on the back of that, and subsequently massive stimulus that has just propelled the markets forward, which is something which certainly when if you spoke to me in March, and I think if you spoke to many people during that period, none of us would have thought that, fast forward to call it end of October, we'd be sitting in a market that has been truly euphoric in a sense of the ability for especially juniors to raise capital, but there's been some large capital raisings, as well as some junior companies that have just been able to not only raise a lot of money, but their share prices have gone up in many cases 5-10 fold, which is just phenomenal.
Yeah, I think no one would have predicted no one would have predicted COVID. No one would have predicted the recovery and the speed of the recovery, the magnitude of the recovery. In some ways, from my point of view, I guess from the small cap mineral resource sector, it's created a situation where finally explorers are getting love and they're actually going out and exploring, and suddenly, I think maybe, correct me if I'm wrong, opportunities are being created because discoveries are being made or getting close to discovery. Yeah. And create this euphoria, like you say, into the market, and people's optimism is growing. Look, obviously gold is, it's the no-brainer that it's doing well. What other sectors are you seeing that has come about because of what's happening?
Yeah, well, I think, I'll move away from resources for a moment, and perhaps we'll talk about some of the technologies. And one thing that has really emerged with enormous strength has been fintech, and companies like the buy now, pay later. And this is not a novel theme. Yep. I think many people have seen the rise of the sector, but it's interesting to think about what's happened and why. And what we've really seen is people in quarantine and people in lockdown, consumer behaviour has been, although we have been restricted and you haven't been able to go to the shops or to move around in public, people have sat down in their living rooms and logged online, and they have continued to spend money. And it tells you something about, I guess, the normal consumer. And companies like Afterpay and Zip Money, very, very obvious examples in that sector, have just completely dominated. And I think e-commerce as a whole, if you look at many of the e-commerce platforms and companies like Amazon, and in Australia companies like Kogan, and recently we floated a company called Adore Beauty as well. These are well tried and tested e-commerce platforms, and they've just benefited from the move to online. It's been a huge customer acquisition opportunity for these platforms, and the customers aren't leaving. So that's been a sector that has just taken off, and I don't think we'll see it ever coming back in terms of just returning to normal. I think once consumers get used to using these sorts of platforms, they continue that behaviour. So quite an interesting observation there, if nothing else. In terms of resources, and I'll speak from a my view of the world, which is, we do deal with a lot of junior explorers in Western Australia. I feel that the strength creates strength in that sector. So going back a few years ago, raising capital for small junior explorers, we'd often raise a very small amount of money. A little bit would go towards working capital, a little bit would go towards just general administration, and a little bit would go towards exploration. The difference now is these companies have been able to raise a lot more money, and the majority of that money is going in the ground. So the exploration spend is like never seen before in the junior sector, and that's across gold, nickel, copper, all commodities, all metals, etc. So, and what we have seen, I think we've started to see a lot more discoveries being made, and I think that's natural. You'd expect that, given the quantity of meters going into the ground, the quantity of activity and exploration is very, very high. So it's natural to see some results coming through, and I think the investor market is starting to catch on to that, and you can see companies that are being active, that are drilling, etc., are getting a lot of retail money flowing into those stocks at the moment.
Hey, it's good. It's good that you mentioned about the other sector, because I think one of the reasons why in my humble opinion, my 2 cents worth, the market's so buoyant is because everyone's doing exactly what you're doing. They're shopping online. They're suddenly realizing that the internet's been telling them, hey, you should be doing this for the last 20 years. But suddenly we've been forced into a corner, and everyone's like, oh, hey, this is actually not bad. So for the trading online or whatever has taken a new sort of dimension in some ways, and so has like what you've mentioned about online shopping and things like that. So this online thing, has that propelled the tech sector more than just fintech forward? Are you seeing that these kind of software companies and all this?
Definitely. I think if you look at the performance, and if you look at the American market being the centre of the universe, especially for large scale tech companies, companies like Apple, massive balance sheet, massive amount of cash. They're just sitting there buying stock back. They've got so much money, they don't know how to deploy it. Companies like Alphabet, Google, etc., they've just dominated the marketplace. You've got Facebook, nothing to say about that. They're dominating that space. Twitter, the share prices, from Twitter, Amazon, and all the rest. If you call it the FANG stocks, they've all just dominated. And there's a reason for that. It's because they're just they dominate their markets, and they just really, really lead. If you look at something like an Amazon, obviously massive marketplace, but they've also got Amazon Web Service. So looking through, say, Microsoft's numbers. So Microsoft came out only I think 48 hours ago with an update to the market. Now their cloud services business, which is Microsoft Azure and Dynamic, they're just massive growth markets, and the growth that they're experiencing is phenomenal. And that would be the same for Amazon Web Services as well. So the movement to the cloud is like nothing ever seen before. And these are massive businesses. So when you talk about Microsoft's 365 platform, it's a massive business, yet it's growing at double digits, like 20 to 30%. That's a huge business that's growing rapidly. So the movement to the cloud and the movement to you look at work from home and all the rest of it, it just makes so much sense that those services are just in demand. As a side note, you would have seen Ant Group, which is Jack Ma's new IPO. I think it was something like 800 times oversubscribed on the retail offer. Raising $34 billion, phenomenal, just absolutely phenomenal. And it tells you what sort of demands out there from not only retail but from institutions for large-scale technology opportunities.
How do people like your local guys in WA and Australia, how do you participate in that growth? Obviously, I mean, I myself have been from a resource background. Now I'm dabbling more into this sector because I can see what you've just described. This magnitude shift to more technical, more online, and everything else. So I've got my few small caps. What can you share with us where these guys should be looking at and what sector?
I think in terms of it is hard being in Australia. We always feel that in Australia this is our universe, so you feel that your portfolio should have Australian shares as predominantly where you're invested. But if you look abroad, massive companies, massive growth potential, and it is becoming easier. So for us as a wealth management firm, we've got a lot of clients that do invest internationally. We can buy direct shares internationally. So if you came to me and said, I want to buy Apple, Microsoft, Tesla, those sorts of stocks, we can buy those for you. But there's a lot of options out there now as well. So for Shaw and Partners, we have an SMA, so it's a managed portfolio essentially, and in some of those portfolios we do have a good blend of international securities in there as well. So they're all the names that you'd expect, and an investor therefore doesn't have to worry about how you pick and choose those. Another alternative has been some of the ETF products out there. So again, as an Aussie investor, it can be expensive and a bit more difficult to set up international accounts and whatnot. You could buy an ETF, which is an exchange traded fund, which basically invests directly in a blend of these international tech companies or whatever it may be. You can choose the product to basically satisfy what you're looking for. But if you said I want to buy all the big US tech companies or international tech companies, you can find an ETF that will give you exposure to those markets. So it's becoming easier and easier for investors to now invest globally.
International stocks, one thing. How about the local stocks? Is there, the Aussie tech firms, which gets a bit sort of ignored, or not say ignored, a bit too strong a word, but they sort of don't get the limelight as much as, especially here in Perth. Everyone's a resource. Every second word's a resource stock. But where are the areas, the local counters that people should be looking at?
Yeah, well, I think there's again, what I from my personal experience, Australia is almost a very good breeding ground for some fantastic companies. If you're looking for those really lofty valuations in terms of growth multiples, Australia probably isn't the best exchange for a technology company that's really looking for those inflated valuations perhaps. But we've had companies like Atlassian that have been born and bred here with Australian founders that they've gone off and listed in the US. So there's reasons for that. Many of the technology companies that we see locally are earnings driven. So although they have fantastic technology capability and infrastructure and people, they are driven by earnings multiples as well. So the market does treat them differently. When you're talking about those novel, call it the FANG stocks, things like Amazon, Tesla, for example. Tesla trades, I'll get the numbers wrong, but 15 to 20 times the valuation of the Ford Motor Company. When you look at Ford Motor Company based on fundamentals and actual earnings, it's a terribly good comparison when you compare it to Tesla, but Tesla's got the valuation because people factor in all the growth around the move to hybrids and EVs and all the rest of it. So when you look at our market, I think if you looked at West Australia, we've got a very strong resources base, a culture of investing in those sorts of stocks. When you look at the East Coast, we've got a very strong base of investing in financial services and large industrial companies and the like. And I think as things progress, I think we'll see a lot more technology companies coming through the ranks. But I think really to get those global peer valuations, I think the US is the natural place for those companies to gravitate towards.
So for you, stay in resource stocks because that's where all the jump is.
Well, it's what we do in WA. It's only a short drive out to the goldfields.
Yeah. In terms, back into the resource sector, we know gold and the nickels all run off, and I'm seeing a lot more talk about sort of the nickel PGE you're hearing a bit more. Obviously, Chalice have come up with Julimar and things like that. Are you seeing that from your corporate side, that there's more interest? Are people presenting those top projects on the table and so forth?
Yeah, I think there's definitely a move towards those sorts of projects. As I said earlier, I think the buoyancy in the sector means that whether you're gold, nickel, copper, coal, iron ore, whatever it is, you've got the appetite to invest in these in the sector as a whole is greater. So people are able to capture the market's attention and then drill those assets. Something like Chalice is quite unique and very special, and it looks like they've had an incredible success story, and rightly so, because what they're onto there looks like it's something quite material. What we find in our markets, which are terribly efficient, is that people look for that style of geology and that style of mineralisation now, and a lot of companies will say, well, hang on, everyone wrote off Chalice's ability to find that sort of ore body, in quite close proximity to the metropolitan Perth area. So now all of a sudden there's lots of companies trying to also identify similar structures. Again, I'd say many of them will try and probably be unsuccessful, but all it takes is a handful to be successful, and it really builds the sector. And we've seen it in my career. I've seen it a number of times, but companies like Samfire, they started a real land rush around their flagship Dulgana process, where their success really brought a lot of money and a lot of attention to that sector around trying to chase copper targets. And it was also Sirius that had their fantastic discovery as well, now owned by independents, and that also started a real land rush in the Fraser Range as well. So I think we're seeing a little bit of that now around Julimar, the Julimar discovery, and but I certainly wouldn't be surprised if we start to see more of those discoveries, given the money's there now to go and target them and drill them.
I think that's the best thing about the excitement in the market, is that the inflow of money into the exploration sector to go for that punt, whether find another Julimar or another Sirius or another Samfire story. I think that's, as we know over the years, many stories have made idiots out of myself and my peers, and a friend of mine said, at $1.10 he thought Samfire was fully valued. But in going forward, obviously, I've been telling people that you should start looking at solid fundamentals, being good management, good projects, good history. Shaw and Partners is a national firm, and obviously you guys have towed the line that quality is better than quantity. Is that going forward? Are you seeing this a bit more now, because the bubble has created some uncertainty in people, in investors?
Yeah, I think investors at the moment are still quite euphoric, and there's certainly a lot of investor demand out there. I think the key with all of these, with markets that start to run quite hot, is to try and retain some quality. So we went from really, the IPO market has been very difficult for many years, and for new resources companies, for example, to list, it has been quite challenging and quite difficult. To now, I've only heard recently that there's something like 60 to 70 companies in the backlog with the ASX looking to list, and that's phenomenal. Like, the number of IPOs that are going to hit the market is second to none. It's just it's gone from being very slow and very quiet to all of a sudden the ASX are basically the bottleneck because they can't keep up. So it's phenomenal. It shows you how much money and appetite for risk there is at the moment. So I think the challenge is really to, and this is always for all investors, it's to understand the difference between early stage assets that are just running on hot money as opposed to those that have got real potential, quality management, etc. So that's always the challenge. It's trying to, stick with the companies and the people that are really going to make it through any boom and bust cycle, because as we see, there's always a few standout companies that really emerge from any one cycle. Many others fall by the wayside, and investors can get caught if they're on the wrong side of it, but at the moment it feels like the demand is still very, very strong.
In terms of how you guys, your peers in this industry, the broking industry, how's Shaw and Partners travelling? I mean, you guys are 12 months old, I guess, in some ways.
Well, in West Australia, Australia, we've been here for actually 5 years, but we had our greater expansion, say 12 months ago. Over that time, we've been able to add more brokers to the business, and we've also added some research capability in-house as well in Western Australia. So our business here has done very well across the network. So the greater network, we're a national firm. We're very large. We are majority owned by EFG, which is a Swiss investment bank. So we've got a very strong business, a very strong balance sheet, and as you'd expect with ourselves and our peers, given the market conditions, it's been a very profitable period for us. We've seen a lot of deal flow, a lot of corporate activity. Transactional volumes were very, very strong, especially during the COVID period, and it was something that took me by surprise, because the swift and the severity of the sell-off when it did occur was like virtually nothing I've seen before. But investors, because it happened so quickly, they reacted also, and so you could really go shopping for bargains, and that really brought a lot of people into the market, because companies that were trading, say, at $20 one day were now trading at $10 or $8, so all of a sudden everything looked really, really cheap. And subsequently that brought a lot of new investors into the market, and that creates a lot of transactional volume, and then those investors have, the majority of people have actually made good money, especially on the blue chip end of the market, because there has been that recovery. So that's really driven the business, and we've seen that really drive us through. So as a firm, we've got over 160 advisors nationwide. We've got offices in every state. Obviously Melbourne has been, in terms of the lockdown, it's been difficult, but again, strangely enough, the business itself hasn't suffered at all. We've got very good technology systems across the business, as you'd expect. Working from home is, we were well and truly prepared for that. We were in a position to be able to do that well, before the pandemic. So I guess all of the anxiety and uncertainty that we went into that period with, we were pleased that the business didn't suffer. We were able to still service our clients, and the business has pushed forward. Over the last 5 years, we as a firm have gone from $5 billion in funds under management to over $20 billion now. So there's been solid growth over that period.
I guess working from home thing is a bit more accepted now, and calling someone else, having a meeting remotely is accepted now, whereas before they said, I'd like to see face to face, but because of the situation, everyone's almost living as it's more efficient. You obviously, I've known you for a few years, and obviously you come from small brokerage to DJs and now to here. Are you the partner for sure being from Europe and things like that, from international, do you see that the flow of funds or the deal flow are easier for you now because of the partnership or the relationship, I should say, than say, if you were sort of a standalone guy and
Oh, definitely. I think our market has gone through enormous consolidation in terms of the broking and financial services business. So we've seen Canaccord merge with Patterson's, which was a West Australian headquartered business. Shores have done its own consolidation as well by acquiring Carmichael's, and that gave them a good footprint in Perth, while the rest of the East Coast business has grown organically as well. We've also seen just recently Euros and Hartley's, two large West Australian firms, merge as well. So you can see what's happening there, and I think there's always a reason for that. One is, you've got, we need to provide more services and better services to our clients. And, when bigger firms are able to adapt quickly, we've got better technology, you've got better compliance, you've got better research, you've got all those things that clients take, I wouldn't say take for granted, but deserve and expect. They don't, now with, I call it, the Comsecs of the world and these online platforms, they expect to have access to data, access to information, and for it to all happen very quickly. So, our clients expect us to be able to do the same. When you're a small firm, it's very hard to provide that same level of service. So, as part of a bigger firm, you certainly have the balance sheet and the ability to really drive and give the customers the experience that they deserve and better quality advice, etc. So that's really critical. With regulation as well, we've seen a massive change across the Australian industry. So we've had new regulation in terms of education reforms for advisors, and that's actually been quite detrimental to the industry in many ways, in a sense that a lot of advisors have said, well, I'm not going to meet the new standards, I'm therefore leaving the industry. So we've seen a wave of probably more older advisors or more guys that have been in the industry for 20, 30 years who have said, well, I'm not going to go through the new requirements, I'm leaving. Now that's the negative side of it. The positive side is when you get through this change, advisors will be better qualified, they'll have more of a it's probably more akin to being a lawyer or an accountant in terms of what sort of qualifications you need to be an advisor. So I think we'll come through the period of change where there's always difficulty in that, but you come through hopefully with a stronger, whether it be reputational or education platform. So I think the industry will re-emerge from this period in a strong way. But again, as a small company, it's very difficult to keep up and to maintain the training that's required and to keep on top of the regulatory landscape. So being part of a bigger company, I think, is without doubt the only way that you can get through these sorts of periods, and not only get through it, but lead the market in that space, which is what we always try to do. We want to be ahead of the curve. Our relationship with EFG as well was something that was many years in the making, and the desire or the intention to bring on a large European partner is to give you a lot of strength in your balance sheet and to also give you that global reach. We've seen what technology does. Technology breaks down the walls of countries. We can buy shares in the US, we can buy shares in Shanghai, you can buy shares in Hong Kong. You can do these things very easily these days. So having a global partner that has reach in almost every major city, I think really prepares us for where the future's going. So that's, to me, really, really exciting.
I think interesting you mentioned, the new products and better products and things like that. And I've noticed that it's just a feeling I'm getting that we used to have your research report was very, very important, very prominent in everything. And then so it sort of faded away. And then I'm slowly seeing it sort of creeping back in again. Is that a correct feeling, or is that I'm just dreaming?
Oh, I think research is critical to any organisation, and I think it goes through. It has been through periods. I think across. This is not in our business specifically, but I think across the industry where there's a real risk that research just becomes a stamped document, and it becomes just a commodity that people kind of just give no value to. Yeah. The key for firms, and the best firms, their research is like gold. It's very, very valuable. There's you've got your smartest people in your firm are working on creating pieces of research that advisors can then digest, understand, and help their clients to make investment decisions with that. So that really underpins a firm. And when you talk about giving good advice to clients, I know a lot of our clients find the research invaluable. You don't always know if they're reading it unless they tell you, but often they'll say, hey, I picked up that note. It was a industry piece about the gold sector, or it was a industry piece about technology stocks, or whatever it may be. And it just creates a lot of value. So the advisors can really speak with authority about certain topics. Clients also appreciate the fact that you're trying to lead the thought process and come up with ideas in some cases, but at least have a view on where industries are headed and where their money should be invested. So for me, it's critical, and it's something that I think all the best firms globally probably feel the same way about. They spend a lot of money on the best analysts, the best chief investment officers, and really building an advisory platform that commands respect, and clients appreciate that.
All right. Well, look, viewers, it's just feel free to give us a comment, or I'm sure they will happily take all the comments from you and filter and answer it straight away. But look, David, thanks for giving us time. I know market's open and you're rushing off, but I really appreciate you giving me time and having a nice chat and giving us your thoughts on where the market is.
Thanks, Noel.
All right.
Thank you.
All right.